Today we're learning what 6C futures are and why people use them. 6C is a standardized futures contract at the CME that tracks the Canadian dollar versus the US dollar, also called CAD versus USD. A futures contract is an agreement to lock in a price for a later date. People use it to hedge currency risk or express a view on exchange rates. We'll focus on mechanics and risk, not predictions. Let's define the instrument. The ticker 6C refers to a CME futures contract on the Canadian dollar, priced against the US dollar. Because it is standardized, the exchange sets key details like contract size, the minimum price, change called the tick, eligible expiration months, and trading rules. You can buy the contract if you think the Canadian dollar will strengthen versus the US dollar due to US. You can sell if you think it will weaken. You also must choose a specific contract month. Now, the mechanics. Futures prices move in minimum increments, called ticks. Each contract specifies the tick size and the dollar value per tick, so small moves can add up. Profit and loss is simple. If you are long and price rises, you gain. If it falls, you lose. For a short position, it is reversed. You also post margin, which is a performance bond, not a down payment. Positions are marked to market daily, so gains and losses are credited or debited as price changes. What tends to move 6C? The Canadian dollar often responds to interest rate expectations, global risk sentiment, and Canada's commodity exposure, especially energy. If markets reprice the Bank of Canada relative to the U.S. Federal Reserve, CAD can shift quickly. Oil and energy prices can matter, but not always in the same way. Watch scheduled catalysts like central bank decisions, inflation reports, jobs releases, and gross domestic product. Also stay alert for geopolitical shocks and risk-off days. Use a simple economic calendar and focus on what the market reacts to now. Before placing a trade, build a plan. Start with your thesis, what you expect, and the specific reason. Then pick an entry area where the idea has a clear edge. Next, set an invalidation point, your stop, where you admit the idea is wrong. Size the position from risk per trade, so one loss does not dominate the account. Consider using limit orders to avoid chasing fast moves. Plan 2 scenarios: what you do if price moves in your favor, and what you do if it moves against you. Around news, spreads, and volatility can widen, so reduce size or stand aside. Use a repeatable workflow. First, check the day's economic calendar and note which events could move CAD versus USD. Mark a few key chart levels, then decide in advance whether you will trade or stay flat. Before you click, set position size and stop placement so execution stays mechanical. Place the order, then monitor only what matters: price, time in the trade, and your risk limits. If conditions change, such as surprise data, reduce risk or exit. Finally, journal the trade, what you planned, what happened, and what improvement for next time. That process is the real edge.